Hello and welcome to A Word in Private, KPMG's vodcast on all things private equity. Hi, my name is Naveen Sharma, UK Head of Private Equity at KPMG, and your host for this series where we will be speaking to a range of guests covering the hottest topics in private equity. Today's topic is ESG, and we'll be assessing the importance of ESG to private equity funds and their portfolio companies. I'm joined today by two guests, Bridget Beals, partner in KPMG and co-head of climate risk and strategy, and James Holley, partner and PE ESG lead at KPMG. So Bridget has 15 years of climate change experience across carbon, energy, and climate change. She works across a range of asset managers to help companies craft their climate strategies and embed this into the operations across the firm, fund, and investment level. Now, James has over 20 years experience in PE and ESG and rejoined us last year from Bridgepoint, an international publicly listed PE firm where he was the head of ESG. So James is responsible for leading our ESG transaction service team and KPMG's PE ESG propositions, supporting clients create value from ESG across the full investment lifecycle. So Bridget and James, a very warm welcome to both of you.
Thanks, Naveen.
Thanks, Naveen.
Excellent.
Great to be here.
Thank you. And thank you for joining. So let's start with you, James, first. Drawing on your many years' experience working in PE and ESG, just good to get your reflections on some of the biggest changes you've seen over the last 10 years in the way PE has approached ESG.
Well, I think fundamentally the industry has moved from a tick box exercise to fully embracing and centralizing ESG in core investment activities. It's no longer about having an ESG policy and being members of the United Nations Principles for Responsible Investment. It's actually about having clearly defined, robust ESG programs in place that integrate ESG at every stage of the investment process. And what we're seeing as well is that private equity funds are putting their money where their mouth is, and they're investing in internal resource to focus in on this area. When I joined Bridgepoint back in 2017, you could probably count the number of heads of ESG in funds on one, two hands maybe. Now we're probably up to over 100, closer to 150 designated people in these kind of roles. So that just goes to show how far the industry has moved over the last 10 years. And I think the other thing to reflect on is the agenda has moved from one of a focus on value protection to actually value creation, and how applying an ESG lens to businesses can unlock value and create better, well-run, resilient companies that essentially contribute to higher multiples on exit.
Excellent. And Bridget, there's a lot of hype around ESG, and I think primarily around climate and decarbonization has emerged as one key theme. Why is this so important to PE, and what should PE funds be thinking about?
When I think about climate change and decarbonisation and this pathway that we're on towards it, a net zero world in line with the Paris Agreement sort of ambitions, I often sort of say to my clients, look, this is going to be the biggest economic shift since the Industrial Revolution. There's no facet of our society today that would be untouched by such a rapid and profound shift in the way that we live. That means that the regulations have to change, both those disclosure regulations that we're all seeing come through, but also, regulations that enable new technologies, new ways of doing things. The capital has to shift along with it, both the debt and the equity. And of course, that means that ultimately, these pools of value that we see across the market will shift with all of that sort of directional change across the market and create real opportunities for good investments as the market sort of transition takes place.
And just building on that, from a PE perspective, what are you seeing from fund level activities, especially on fundraising? And what are the key strategic factors a fund needs to look at?
So I'm seeing my clients really start to lean into that big change agenda at the fund level. So starting to really think about how do they implement responsible investment policies, and how does that start to link to some of the new regulations that are coming through, and the attraction of that redirection of capital through things like the Sustainable Finance Disclosure Regulations, the SFDR. How do they launch things like Article 8 or Article 9 funds, which embrace those ESG characteristics, things like avoided carbon emissions or other social impacts as well. So they're really starting to think about how they embrace those. We're also seeing a big wave of new thematic funds being launched, things like impact funds, energy transition funds, which are leaning into that redirection of capital into those new emerging value pools. So, with the new IRA in the US, obviously huge investment going into renewable technologies, hydrogen, CCUS, direct air capture, all of these technologies, and I'm really starting to see funds being launched that would capture that big growth opportunity.
Thank you. That's from the fund level, the GP level. But James, is switching to the LP side, limited partners. What's driving their agenda, and how is that linked then to what the GPs are doing?
Well, I think fundamentally ESG has become a license to operate and a gating factor in fundraising. We're seeing, as Bridget mentioned, a lot of capital flow into ESG positive funds, which LPs are obviously influencing and driving, and fund labeling regimes that SFDR that again Bridget mentioned are also driving that. And I think it's critically important that private equity embraces this. Otherwise, they run the risk of potentially not being able to raise their next fund.
So is it linked to that? Is this regulatory driven, or is it a change coming from LPs?
Well, I think just sort of building on that point around wanting to invest in environmentally and socially conscious funds, a mandate to invest responsibly. They have beneficiaries that they need to convince and to be custodians of their investments. So I guess that's one of the key drivers. I think what's interesting. And what is becoming challenging is that LPs are also becoming more thirsty for ESG data and are asking more and more challenging questions and requests around ESG information and ESG data from their GPs. This is a huge challenge. It's time consuming, it's resource intensive, and it's actually driving up costs. Private equity needs to respond. But it isn't easy. We're seeing convergence of regulatory standards and reporting standards, but there's still a long way to go.
Okay, that's very interesting. But now moving on to from a deal lens, I'm trying to understand what does it actually mean in practice. How can deal teams actually apply an ESG lens to the origination and due diligence process? And if you could be quite specific with examples, how should they embed that across that process, especially when you start looking for new investments and you go through the entire diligence phase? This is an important part of a deal process. So good to get your thoughts on how ESG could be embedded better.
And Bridget, feel free to chip in. I think three things for me. Deal teams, I think, should consider ESG as an investable theme in itself. Investing in businesses, innovative businesses that can solve the world's global ESG challenges is a significant opportunity, or pivoting existing businesses to more sustainable, greener products. So I think that's a real source of value creation. I think second, it's about bringing ESG into the conversation early, engaging with prospective management teams on the topic, and bringing it early into your due diligence process, and utilizing ESG expertise to help focus on what is materially relevant to the company that you're looking to invest in. We often see, boards of companies not taking the ESG agenda seriously, and that is often a signal that the ESG approach within that business is quite immature. Third and last is that I think engagement, once you've acquired a business, is how you work with the management teams of those companies to unlock ESG, to apply that ESG lens to drive value. We often see with companies backed by private equity that they're quite early in their ESG journey. They're actually doing quite a lot of good stuff. They're just not bringing it all together at the top to provide that coherent strategy and narrative. And, we often see companies that have strong ESG programs are actually better equipped at attracting new talent and retaining staff. So it's a real source of value creation opportunity.
Which it's a perfect segue into a question, actually. Could I, maybe Bridget, coming over to you, using the climate theme here, how do private equity firms use climate to drive value creation? Could you be quite specific? Because we hear this a lot of time as a value creation tool. How do we know it actually does generate value? Is it exit value? Is it enhancement in earnings? What is the value enhancement that comes through here?
Yeah, absolutely. I think it comes down to three key areas: operational efficiency, cost of capital, and then thirdly, the real sort of leaning into those growth sort of value pools as the market shifts. So I'll go through each of those in turn. So on this first piece, operational efficiency, and I hear a lot of the time, ESG is just good business sense. It is, but it's also more than that. And what do we mean by that? We mean for most companies, there are significant reductions they can make in things like energy spend from just better efficiency with how they use energy across their business, whether that's energy efficient heating and cooling systems, lighting systems for real estate assets, or in the heavy industrial sort of side of things. I've seen instances where companies have been able to save hundreds of millions of dollars a year on their energy costs simply by really embracing the big data that's coming out of those systems to optimize energy use across those industrial processes. So operational efficiency that drives cost out of the business is lever one. Secondly, it's around this cost of capital play. So when we want to access debt to leverage an investment, we need to think about where those lenders are actually trying to reposition their portfolios as we move forward. And obviously we see through the Glasgow Financial Alliance on net zero, or the Net Zero Asset Managers Alliance, etc., that lots of these asset managers and banks are also realigning their portfolios, and they will do that with pricing of credit. But we also know that ESG and ESG credentials specifically are being valued. So we've done a lot of analysis around listed company valuations and how that correlates to ESG performance. And there is a positive correlation between ESG performance and that equity valuation that's being made across those assets. So there's a really clear case there that across equity, across debt, better ESG credentials can lead to better valuation outcomes. And obviously in a private equity context, that would mean a better exit value. And then finally, if we come into those value pools, this is really about how you consider what the investment is actually doing and how there are adjacencies or synergies in terms of that change that's happening across the market that this company could lean into. So I've been involved in examples in oil field services companies, for example, where we've helped them to pivot their business plan to capitalize on the opportunity in supply chain services for offshore wind, for example. I've been involved in transactions where we've looked at biodegradable plastics in place of single-use plastics and how they could gain market share by actually leaning into the demand from their customers for products that were actually delivering ESG credentials, protecting and creating a resilient business, as well as opening up whole new revenue streams for the businesses as well. So there's three real levers there that all come back to ESG as a key value creation lever.
Thank you. I think that's very, very clear, actually. So just linking that to when you mentioned exit value, James, any top tips for PE funds and portcos thinking about exiting a business, what they should do? How should they prepare themselves, especially from an ESG lens, so that they don't get some really difficult questions from buyers and they're not ready?
Well, I think it comes down to having that clear ESG narrative and making sure that is linked through to the business plan and strategy and the equity story. I mean, we saw a few years ago one of the global fast food giants in the gig economy that on IPO on day one lost billions in value due to ESG issues. So these topics are seriously important and need to be factored in to the exit process. I think it's about using vendor due diligence to help, articulate how the business is managing the key ESG risks that could impact value or could impact reputation, to give comfort to prospective buyers that they're being well managed. But then it's also about taking that assessment on and summarizing the positive ESG initiatives that have been implemented throughout the PE ownership that have helped to create both commercial and social benefits. ESG really can impact the exit multiple, and Bridget's just mentioned some great examples there. I've worked on a deal for a business in the agrochemical sector that during the private equity ownership really embraced ESG and used it to pivot away from using kind of harmful chemicals to more greener, natural products that not only benefited, the environment and society, but also created a new revenue stream out of a greener product, and that flowed through to the exit multiple. So I think it clearly can have an impact. The challenge within private equity is drawing that link between ESG and value. And I think what I would like to see is, in all the communications and the ESG reports that we're now seeing from private equity, that we hear more about those case studies where ESG and climate has impacted, the valuation and the multiple, and share those within the industry so we can bridge that gap.
Clearly, if you haven't had the prep you talked about, you haven't had the journey, but now you're on that reflection here, we need to do something, but you're also on the exit path. What could you do then?
Well, try not to panic. I think clearly maybe turn to ESG advisors and third parties to help, assess where the business is currently at, to try and give some comfort that, material issues are being well managed. And I think it's a case of, trying to package that up in a vendor report to at least articulate that, some of the key issues are being managed and dealt with, and therefore, the buyers should not worry that there are any, unknown issues that could come back and bite them.
Okay, interesting. Bridget, any additional thoughts and reflections you may have?
I'm not sure if we've said the word value enough today. So, I mean, my key reflection for this whole conversation is really just value. And specifically, my advice is to try and win those hearts and minds of the deal teams around the connection between ESG and value. That's something I hear a lot from my ESG contacts across the private equity industry is, well, we get it, but when I talk to my investment teams, they don't see that connection. So we've got a real hearts and minds debate to win on this. There is value, and we just have to really ruthlessly focus on demonstrating that across the marketplace.
I think in each episode, I want to end with 3 top takeaways from the discussion. So from today, I'd say, listening to both of you, and please correct me if you think otherwise, ESG is no longer a tick box exercise. It's not about compliance. It's all about the value and the value created throughout the full investment life cycle. So I think that's one key takeaway, linking it back to value, right? The second one I think is quite important, actually. It's about, I think we are seeing it more and more now that PE funds, ESG is a license to operate, right? So LPs require it, and failure to proactively embrace it and have, as you mentioned, robust data to back it up could restrict access to capital. So that's probably a second important takeaway. And the third one, which I quite like, Bridget, you mentioned earlier on, the transition to the low carbon economy is the biggest market shift since the Industrial Revolution. That's a pretty big statement. I think this presents a huge opportunity for private equity and its portfolio companies, but failure to embrace it could mean you get left behind. So I think it's an opportunity as well as a potential challenge. So I think those were my 3 takeaways. I hope you agree with it. And I think we're probably coming to an end of this. So I just want to say thank you again for joining me today. I've really enjoyed delving into the importance of ESG to private equity funds and their portfolio companies. The next episode is on cyber and the importance of cybersecurity to PE and PE portfolio companies. I'm Naveen Sharma, and this was A Word in Private, KPMG's vodcast on all things private equity.